Thank you for tuning into the Collecting Real Estate podcast. We focus on learning and teaching based on our guests' journeys operating their real estate investments and providing investment knowledge to passive investors so they can comfortably invest in multifamily real estate. Hey everyone, welcome again to the Collecting Real Estate podcast. We have a fantastic guest this morning. This is Jake Clopton of Clopton Capital out of Chicago, Illinois. It's great to have you this morning, Jake. Please tell us a bit about your real estate background.
Great. Yeah, thanks for having me on. Appreciate it. So my real estate background goes back about 15 years. So before I started my company, I used to trade interbank hedging product futures like 3-month LIBOR and Fed funds and stuff like that. And then in like 2008-9, right, like that whole thing kind of evaporated. So I was looking for something else to do. And I ended up thinking about raising money for real estate projects and businesses, right? Because that's what was going on. It was a credit crunch and it was hard to get financing and liquidity was scarce. So, the idea was to find people loans and equity and money. And 15 years later, that's what we're still doing. So our company today, right, I do all our capital market stuff. But our company has a couple different silos. We're also a commercial real estate property insurance company. All we do is focus on CRE insurance. And then we also have another side where we do like pro formas and financial modeling and investor reporting. A lot of our clients are like syndicators, so what we do is we kind of like offset or outsource like the time constraint of putting together models and stuff like that so they can go and find more deals. But then what I focus 100% on is capital markets, right? So the deals I do are like, ranging debt and LP equity, for deals that are like a couple $1 million up to like 300-400 million. It's like some of the largest stuff we've worked on. Pretty much all asset classes and all over the country. So that's us, man. And then, I personally have a portfolio of multifamily properties around Chicago.
Excellent. Yeah, there's a lot there. I appreciate you jumping in 2008, 2009. And I'd like to talk to you a little bit about that, and then we'll segue into these different aspects that you're involved in now, from your apartment communities to the insurance and all of the finance that you have done. But explain to the audience, what was it like for you in your business in 2008, 2009? How did that feel? What were you thinking? And how did you bridge that to 2011?
Yeah. So around, I have some personal things going on around that time period also. Like, when you trade futures, you trade, like my schedule was started at 5 p.m. on Sunday evening. And I would work, throughout the week from 1 a.m. to 4 p.m. every day, and it would end at 4 p.m. on Friday. So let's just say I was done trading. Like I was done. Yeah, you know, life everything. But the time to get into a bit into like any industry and to start a business on your own really is when there's a downturn, right? That's your entry point. That's when like it's less competitive. Like people are much more willing to talk to you and to talk to new resources and stuff like that. And the thing that I am really good at and was really good at back then is just cold calling, right? Literally all I did was just start making phone calls to banks and credit unions and private equity funds and just call and just, trying to find liquidity and trying to find people that were lending. I was a machine, right? I make like 150 calls a day to people. I would say that is probably one of the number one reasons why it kind of worked out, just because, I wasn't hesitant to cold call people out of the blue and really to put the effort into, finding the stuff that I needed to provide, owners and operators with, which was loans and liquidity. But yeah, I mean, it's times like 2008 and right now, candidly too, that are phenomenal entry points. I mean, I know it seems like it's counterintuitive, right? Because I was like, oh my God, there's a recession and things are tough out there. But now's the time to do it, man, for sure. And then, you can get kind of like a placehold in the industry in times like these and then kind of ride that wave upward, when things kind of come back. Take some time, but that's definitely time to do it.
That's why I love asking that question right now, because we're right in the, what does Ken McElroy say, in the third inning of a 9-inning game. I'm not sure where he thinks what inning we are now, based on this recession or whatever we're involved in at this point. But it's so,
I feel like we're in the ninth inning that just won't end. You know what I mean? Like, no. We just can't get out of it. It just feels like it's going on forever. Right.
But it's so funny because we're all able to go back into 2009, 2010, and whether we had success taking advantage of the opportunity or didn't, to go back and say, wow, we should have just done that. It's obvious that what do they say? I think Warren Buffett said, get in when there's blood in the streets, because that's when we make the money. But now, as you mentioned, we're in an uncertain period of time. So yes, it's a great time for opportunity, but in real time, that's where the rubber meets the road. What are we doing now? Because it takes courage to jump on this when there is, I don't want to say blood in the streets at this point, but it is very, very uncertain. And some of us who have been in the business and consider ourselves aggressive and very opportunistic, it's still challenging to say, all right, when that next deal comes along, I'm jumping on it.
Right. I think it definitely takes patience, right? I mean, if you are opportunistic, right? I mean, now's really the time to be looking for great opportunities, right? I mean, and candidly, this is what, my fourth downturn, something like that, since I can remember. It is what it is. I mean, they're all a little different, but it's not like we're not going to come out of it, right? I mean, it's just called a cycle for a reason. But yeah, I mean, just think about it. Think about trying to make an entrance into a market like 2019 was, right? When it was just hyper tight margins on everything and everything was so competitive. And, for us on the lending side, it was like you would argue over every basis point of a loan, right? And now it's just different. And candidly, like some of the opportunities I'm seeing out there right now, that maybe aren't as apparent to other people, like are some of like the best deals I've seen in 10 years. So they're out there for sure. I mean, if you're only looking at the same things that you've been looking at for 10 years, then there hasn't been an opportunity that's appeared in that market. Yeah, you're probably going to think like there's nothing to do. But if you start looking around, maybe at different asset classes or different areas, or maybe different strategy. I mean, there definitely is stuff that's popping up out there. And I think, now that we're getting to the point where people are getting more clarity on like where rates are going and kind of what's happening, like uncertainty, like widens spreads, right? And, as that uncertainty comes in, like the spreads between like bids and asks in the market and, just other things will come in. And I tell you right now, I'm like one of the busiest we've ever been. And people have definitely jumped back in, and there's a lot of activity going on.
Very interesting. And seeing that you have gotten into a lot of different asset classes over the years, what is your desire at this point? I'm an apartment guy. I've got about 300 apartments that I have assets under management, and the financing is interesting. We look at it as 95% of our career rates were between 5.5%, 7%. So it's just another line item that we have to underwrite. Right now, we're going to underwrite at a 6% interest rate. And if we want to refi in 3 years, will be conservative and probably be, 7 to 8%. So we're insulating ourselves from any type of crazy uncertainty. What is your mindset as far as, are you looking at apartment communities as opportunities or a different asset class right now?
Oh, sure. I mean, look, I think there's opportunity in everything. It just depends on where you can enter that asset, right? I mean, I'm seeing, I like to use yield on cost to really gauge, like, a lot of the deals we look at. And, I'm starting to see deals that are like, 7.5, 8 yield on cost in multifamily, which is phenomenal, on untrended rents. And, I mean, you didn't see those, a couple of years ago. And, there's still some deals out there. And yield on cost, for everybody doesn't know, that's basically, you could kind of relate that to like the cap rate of where it stabilizes, right? It's where the cap rate where you're going to own the thing after you can do whatever you're going to do to it. And like there's still some deals out there that are really pushed. You know what I mean? Like I'm still seeing people trying to push like 5.5 yield on cost. It just doesn't make sense, right? I mean, it's not the right time. It's either too expensive to get in, or there's something's happening, or you can't push rents to where you're trying to get to. But there are definitely some good deals out there, and people are finding them, right? I mean, sometimes it takes a little engineering to get there, but it's definitely happening.
Let's talk about that on that lending side, because you're going to have your clients who are still underwriting deals, still trying to do deals, maybe some sitting on the sidelines. What are you seeing as far as that lender perspective? Obviously, you're underwriting and looking at deals differently than you were a year or two ago. What's that volume like on the lending side?
I mean, look, lending is just a math problem, right? At the end of the day, that's all it is. And just today we're plugging in, higher numbers than you used to before. And that's really just all it comes down to. And because of that, a lot of deals, people kind of go into some deals thinking like, hey, we're going to get 85% loan to cost in this, no, you're not. The exit's not there, right? I mean, so I get that call first, especially in bridge lending, so rewind back to like 2019. There's a lot of multifamily deals that went off, right, in the CLO market. That were 85% of cost, underwritten to 4.5 cap exits and 4% interest rate exits and all this stuff, right? Those deals are stuck, and because those are the type of deals, like it was definitely the basis was way too high, right? And you needed that super high leverage to make the returns on the equity work, right? That's what I think the biggest difference is today. The deals that needed to go off with super high leverage just to make equity returns work, those really aren't happening right now, right? It's deals that have actual economics without crazy high leverage that are happening today. And those like hyper push, super high leverage deals, that were kind of just, financially engineered to make it look like a good investment to the equity. And I hate to say that, but that kind of was, right? Because that's what you needed to make it work. That stuff has kind of gone away. And what we're seeing is a lot of those deals that are on bridge loans or whatever they were coming due, and they're cash in deals, right? They're cash in pref or they're capital calls, or I don't know, something's going to happen. But, generally speaking on the lending side, I think there's a couple big themes. I mean, one, banks are in this precarious position because of, obviously what's going on with Silicon Valley Bank and all that stuff. A lot of them don't really know what they can do right now because there's definitely more regulations coming down the pipe from like the FDIC and all that. So a lot of them have just kind of like, taken a step back. That said, and I always say this, there's like 5,000-6,000 banks in the country. Every single one of them has a different portfolio and they're all different. So we have banks that are hyper aggressive right now because they have huge allocations of capital. So I really think, when you're going out there and looking for lending, there's really no like one single answer to the whole market. You really got to, especially in like markets like today, you really have to hit the right guys at the right time to get the best deals. And you'll go out there and bid a loan and you might get a spread of rates like that are 200 basis points wide of each other, for the same exact deal from similar lenders in the same geography. So it's definitely an interesting market. But it is very fractured. What's going on? Like some guys just can't lend, and others are aggressive. So it's interesting times.
Yeah, it's funny you say that because we're refinancing a deal now outside Knoxville, Tennessee, and going through different brokers that are going to agency debt. And yes, getting a wide range. And it's my first agency deal. And I'm confused how, well, you're all going to agency. You're all, I'm assuming, going to the same spot that's giving you a very, very similar product. But why are brokers giving us a wide range?
Yeah. So look, agency debt is CMBS, right? But it's just agency CMBS. So yeah, they are all going to the same place, right? There's only one Fannie, there's only one Freddie, all that. But certain originators are different, and certain types of originators can delegate kind of what terms they go off, and they don't need as much scrutiny in the back end. And others can't. There's other reasons why, right? I mean, one guy's underwriting it a little bit differently than another, or, one lender actually is just unwilling to push it as high. It's similar to when you go to the conventional CMBS market, right? Like they're all selling to the same market, right? And this is the way it works. They close a loan and then they sell it off into the CMBS market. But, that doesn't mean that every single one of them is willing to close the loan on their own books the exact same way and then sell it off. I mean, there definitely is some differentiation, and a lot of that comes from it's either, how aggressive that particular lender is. Do they have bad loans that they haven't been able to sell that they originated that are sticking on the credit line? That's a big one. That's not such a big a deal in Fannie and Freddie, but in conventional CMBS it is. And then also kind of how much, profitability that originator, is building into the loan itself. That can obviously dictate kind of where their spreads are. So there's various reasons, but yeah, I mean, you're not wrong. Like, they're all going to the same place, but not every originator is created the same way. So you definitely need to, like when you go to Fannie and Freddie, they're all going to tell you, don't go to anybody else, only go to, yeah, but as you've figured out, you do have to go to different guys, right? Because you don't get the same answer everywhere. So.
No, I appreciate that explanation. Yeah, you go to these different originators. Yeah, they're all underwriting it a bit differently, and they all probably have a different appetite of what they want to bring to their agency source, and everyone's going to be a bit different. Last question on this financing side, just because I wish I was a fly on the wall with a bank's portfolio and what they're discussing right now based on what you said with some of this bridge debt coming up and this appetite and desire for so many people to do these bridge loans a year and a half ago or so because it was the only way or one of the great ways to make deals work. But we're seeing some stuff now in the news where there's been some major foreclosures happening. And are you seeing anybody in your sphere, your inner circle, that some of this bridge debt's coming up and they have a crisis on their hands?
I mean, I wouldn't speak to any one group in particular, a granular group. There's this bridge debt issue is something that's extremely well known, and it is an issue. There are lenders that are creating programs just around this, right? Bridge lenders out there to kind of to refinance some of the CLO stuff. Here's how we got into this mess, right? This is primarily and I don't want to pick on syndicators at all because there's a lot of great syndicators out there, but it's kind of like a flaw in the syndication model to a degree, right? Where people haven't dealt with this before. Is that basically think about a syndicator, right? You have your syndicator guy who's the GP, and he's probably syndicated out some of that GP money too, right? And then maybe he's 10% of the equity, and then he gets 90% of the rest of the equity, which is LP, right? From whoever, various sources. So basically all the money is raised to a degree, right? And then to get the highest IRR of this deal, right? A lot of the deals that were happening in 1819, they were super high basis. So you needed very, very high leverage to make the deal work, right? A lot of what was underwritten and, the equity returns in 1920, all these areas, they were also underwritten at, trending rents, right? So like the returns that they were underwriting were even based on rents that didn't even exist in the marketplace yet. It was just, hey, the rents are going to grow to this, so I guess people didn't really account for inflation back then. But what happens is now that in a lot of these syndicators, right, first of all, a lot of these, you can kind of blame some of these conferences that went on and everything, and like, hey, syndicate stuff and raise this and that, but a lot of these people weren't really around like pre 2008 they just grew up in an environment for the past 15 years where there's been, artificially low interest rates. And realistically, there was always this Fed put, right? And rates just didn't go up. And now that they have gone up, it's really caught a lot of people off guard, and they just didn't see that coming. The issue now is you can't exit that debt where you modeled it, right? And so what do you need to do? You need to pay down, but the syndicator model doesn't work with a pay down because the syndicator himself doesn't have, normally a whole bunch of liquidity sitting around. And so you're basically left with, a couple of choices. Go back to your LPs and with a huge capital call, say, hey guys, you've got to pay this down. Which I don't know, probably ain't going to happen, right? Depends on who your LPs were. If you syndicated out to $50,000 at a time or crowdsourced it or whatever, that's not going to happen. There's a lot of pref equity out there, like gap fillers that has kind of come in the market. I think that's probably, your best option. If you are in one of those positions because, it's higher yielding, but you're also preserving your upside. Right, because pref doesn't really participate in the upside, right? You're just kind of giving away like an expensive piece with a higher cap stack. Or really, sell the thing. Really, there's only so many options. If you're anybody else who didn't syndicate this thing and probably has much liquidity, they're just going to pay down the loan or they'll figure it out, right? And they'll be able to preserve their equity. But as far as like these syndicated deals that were done with super high leverage, it's just going to be an equity loss in one way or another. There's really no way around it. So.
Yeah, it's a challenge. It's a challenge. So yeah, what LP wants to hear about a capital call? And
no. And yeah, but then the question is, okay, well, how much of the GP do you give up? Right? I'm guessing not much. So,
yeah, and if you have to go get gap funding, that's just going to dilute the equity. Also, returns go down.
Yeah. I like the idea of pref, right? Because you basically. You don't give up the upside, but you're basically just giving away your cash flow in the meantime until you can sell it.
Absolutely.
Right. So, that I think is probably one of the better options if you can do it. But it just depends on how tight the deal is.
Excellent. Going forward, now we're underwriting our next deal. And insurance, you're in the insurance business, and insurance is becoming an issue also. So we not only have to talk about what we're doing for debt, we're also talking about insurance. When we're underwriting a deal, make sure, like if you're in Florida, insurance keeps going up and you don't want to underwrite very low on a 100-unit deal with insurance because you may get unpleasantly surprised. And also going forward, is the property management, making sure that we're really focused on operations because we're in an uncertain period of time here with rent growth. Rents are going down, supposedly. What are your thoughts with all of that?
So insurance, yes. We started our insurance platform a couple of years ago, started seeing this happening, right? And I'll tell you, insurance is one of those things where for the longest time, people were just like, it is what it is, and they didn't really pay attention. But now it's becoming a bigger and bigger percentage of your expense load. especially in Florida. I mean, the wind insurance in Florida is nuts. I mean, I've got guys that are like, listen, just find me a lender that won't require me to have wind insurance. Otherwise, this deal just doesn't work, right? I mean, we'll take it on ourselves, but otherwise, this deal just doesn't work. There is a huge shift going on in the insurance marketplace, and it's really coming from the top down, from the reinsurance companies all the way down. But yeah, in a lot of markets like Florida, I mean, you have you have some insurance companies that are just completely leaving that marketplace. I mean, we're in a little bit of a different position, right? I mean, we built our insurance agency around only commercial real estate guys, right? So there is a factor when you're going out to bid insurance where, you get an insurance agency and they're not really specialized in CRE insurance because it is kind of specialized, industry. And they just don't really have the resources. And we've been able to, go into a lot of, scenarios and just cut premiums just because, we're focused and we have better resources, right? There is a degree of that. But on the other hand, the premiums across the board are going up. And a lot of times, guys are getting sticker shock because they'll get a renewal 3 days, before they're in policy renewals, and the premium's gone up 150% in some of these markets. I mean, if you're coastal, you know what I'm talking about, right? So yeah, I mean, the days of, and what I would say is just best advice for anybody, the days of just auto renewing your insurance policy and not marketing it every single time are just gone. Right. I mean, you have to put the legwork into insurance today. Find somebody that, like us or somebody that specializes in CRE insurance. Like if the guy's also trying to sell you life insurance, move on. I mean, I'm sorry, but there's more resources and there's new resources that are coming out there and kind of filling gaps in markets where other guys are leaving. But yeah, I mean, it's definitely something people need to pay attention to. Because hey, as your expenses go up, that affects your NOI, and it's a real, effect on your property value at this point, especially for some of those, Florida coastal, Texas properties.
Yeah, without a doubt.
What was the next question?
Well, next question. Sorry to give you a compound question there, but yeah. Right now, I'm focused on. I've always been a property management guy. Now I'm more of an asset manager, but I'm wired at this point. I'm wired at all points, but specifically now on operations. Really delving in and being clear on where our rents can be, where they should be, and also just focusing in on labor and everything else that affects that operational aspect. And I know that you have some apartment communities. So what's your day-to-day, month-to-month with your operations?
Yeah. So I have a third party property management company, right? That basically handles everything. But, because I run, our other companies. I wish I could be there, more to do it myself, but it's just not realistic. And I like to invest into things that I know, right? So that's why multifamily. I would tell you, expense management is, just as, if not more important than the rental side. I mean, you can blow out expenses so fast and so quickly, especially in today's world. I mean, just utility cost alone, around Chicago, water bills have doubled, taxes are going through. I mean, it's like every single line item has just gone up substantially. And it takes a while to pass those costs on to the tenants through rent increases. So expense management has through everything, insurance included, has just become a huge part of this puzzle. And that's what I'd say is probably the biggest issue in today's world is just expense inflation. Because I see it, I know everybody sees it, and kind of getting that stuff under control and trying to figure out how to kind of stabilize that without it going up, I mean, it feels like it's going up way more than inflation, right? I mean, it's like 10, 15% a year. It's not like 7 or something, but so that's definitely a challenge for sure.
Yeah, that's what my wife says, completely outside business. She's like, this inflation, this is BS. I go to the supermarket and it's more like 20, 30% inflation. And getting back into our world, it's all these line items exceed any of the inflation that they're talking about. And
I'm like eggs going up 20%. My tax bill went up 100%. How about that?
Amazing. So, yes. Yeah. So it brings me back to, because I like those value add high rent growth deals. And that's all I've been focusing on the last 2 or 3 years on the scaled up version of apartment communities. And we go into a deal and raise some rent because we're buying places where they're well under, and we have a script where it's saying, hey, here's your renewal. We understand it is a pretty large increase, but we're going to be improving the outside. We're going to be improving some apartments. And also in this period of time, water's going up, insurance going up. All of these costs are going up. So we're able to educate the tenant a bit to know that we're just not coming in and just wielding a stick and jacking up their rent. And that's just the period of time we're in.
Right. Yeah, I mean, look, it is what it is, right? The reason you bought the property was to increase its value and raise rents. I mean, for sure, you got to deliver it, softly. That definitely helps with stickiness of tenants and, them just not getting mad and leaving because, it's always great if they just renew at a higher rent. But, I mean, listen, what can you do when, your expenses have gone up, across the board 25%? I mean, it's got to be passed on. There's nothing else to do, If you want to run a charity, you can not raise them and, operate the building at par, but I don't think that's why anybody is in it, right? So, it is what it is.
Absolutely. What I want to shift into now, I see that you're also an author. You wrote the book, Commercial Real Estate Investing, Understanding, Finding, and Funding Deals in Today's World. When did you write that book, and what can you tell us how we can incorporate that today when we're looking at that next deal?
Yeah, so that was early last year. We published that, and it's really I tried to give there's just so much you could say, right, about just different aspects of everything. So really tried to give, my insight into just the general, the different areas of commercial financing, different types of loans and lenders and kind of all money's green, but it definitely has different personalities depending on where it's coming from. You know what I mean? So really understanding where your capital's coming from and what that capital wants, I think definitely can give you better insight on how to successfully finance something, right? Other than just 'cause I feel like a lot of operators kind of say, hey, this project's phenomenal. Every single lender on earth should be willing to give me the best financing, but if you're going to the wrong places, I mean, some lenders just can't do that, right? I mean, they are, they have lenders themselves and they have a certain cost of capital. So really understanding where that money's coming from with some of the impetus of that. And then also just kind of the insight I've gotten from talking to people over 15 years about how they're finding deals and some of the strategies to find off market stuff and this and that. I think it's a great kind of springboard for somebody that wanted to get into commercial real estate, and have a good, solid base understanding of, kind of how to finance stuff, what are the different options, and then, how to find deals.
Awesome. No, I appreciate that. Everybody go out and get that book, Commercial Real Estate Investing, Understanding, Finding, and Funding Deals in Today's World. Jake, this is the Collecting Real Estate podcast. So they say you have to have 3 of something to make a collection. So we're going to wrap this up with 3 questions for you. Number 1, In 5 words or less, what's the most important thing you've learned since you started collecting real estate?
That real estate is a business, not just an investment.
Excellent.
I think there's probably no faster way to lose money in real estate than thinking that you're just going to set it and forget it. Like, I'm sorry, I hate the term mailbox money, all that crap. Like, if you're not paying attention, man, like it might work for a little while, but you're going to get hit, you know? So I would say that, like, no, look at it as you're running a business. Your tenants are your customers, and I think you'll do well. So.
Yeah, even in a syndication, I've heard people talk about, and there's massive truth to this. Even as a LP, or also known as a passive investor, with the mailbox money, nothing's 100% passive. If you want to invest $50 or $100, $200,000, you're not just writing someone a check and assuming that you're going to have mailbox money coming in returns. You still have to do your due diligence, research the operator that you're considering investing with, underwriting to a certain degree. So there's still work involved.
Right. I mean, think about it. Yeah, I mean, you're effectively investing into the syndication and hiring the GP to run it all, right? But, I mean, keep in mind, it's not like, I don't know, like Merrill Lynch or something, right? Where there's all this oversight. It's just a guy, and who's watching him.
Right.
So you definitely got to be right. So, if you just go look around the news, you'll understand why we would say make sure you're paying attention to any of these syndications you're investing in.
But still, all you passive investors out there, anybody considering to do it, we're gonna deliver. If you get with the right operator, we're gonna deliver much better returns than Merrill Lynch. I can guarantee you that much.
100%. 100%.
We're in real estate for a reason here. I don't want to downgrade that. Real estate is the best investment vehicle you could possibly get into. Second question for you. What are your 1 to 2 year personal goals?
Personal goals. Good question. I mean, a lot of it revolves around, just, expanding the business. But I would say in general, just, continuing to focus and, get healthier. If I would say anything is the best personal goal, it's just really, take care of myself as much as possible, because if this machine doesn't work, nothing else does. So, you know what I mean? I'm sure everybody can appreciate this. Get better sleep. How about that?
Yeah, absolutely.
You know how it is, man. I mean, if you ever read that book, Sleep Your Way to the Top, that is definitely legitimate good advice.
That's a new one. I haven't heard of that one. I have to check that out. Third question for you. How can we and the listeners assist you, and how do we contact you?
I am exceptionally easy to get a hold of. Except I think I've hit my maximum number of LinkedIn connections. I have 30,000. I think I have to delete some people. So you can hit me up on there as much as you want. It might take me a little bit to respond. Otherwise, our website is cloptoncapital.com. Give me a shot anytime. This is all I do, so I'm more than happy to chat about deals.
Fantastic. All right, go to cloptoncapital.com, and once again, get the book, Commercial Real Estate Investing, Understanding, Finding, and Funding Deals in Today's World. I really appreciate having on the show today, Jake. Thank you very much.
Thank you. Likewise.
All right, have a good day.
You too. Take care.
Hey, everyone. If you enjoyed this episode, please give us a review and 5-star rating. This would be very helpful to us. It allows us to build momentum in the podcast world.